Hello to everyone. I am Nicolas Bornozis, President of Capital Inc., and it is my pleasure to welcome you back to our Trending News series. In today's episode, we are pleased to have with us Mr. Eddie Valentis, the Chairman and CEO of Pyxis Tankers. Now, before we begin our conversation, I'd like to share a brief overview of the company. Pyxis Tankers currently owns a modern fleet of 6 mid-sized eco-vessels, which are engaged in the seaborne transportation of a broad range of refined petroleum products and dry bulk commodities. And the fleet includes 3 MR product tankers, 1 Kamsarmax bulk carrier, and controlling interests in 2 dry bulk joint ventures. Pyxis common stock is traded on the NASDAQ capital markets under the symbol PXS. And now, before we begin our discussion, just to remind everyone of the usual disclaimer that this discussion is purely for informational and educational purposes. It should not be considered investment advice or or advice of any kind. And of course, it is not an offer to buy or sell securities. And also, as an additional disclosure, we have the privilege to work with the Pyxis Tankers on investor relations. Eddie, thank you very much for joining us again. This is a great opportunity to review the company's recent performance and especially to get your perspective on industry dynamics and learn more about Pyxis Tankers' strategy going forward. So let me start our discussion with a question on the short-term outlook. In the second quarter of 2025, the MRs in your fleet reported an average daily time charter equivalent of almost 20,700 per day, and the bulkers around 12,800. So how is the third quarter of 2025 pacing? How is the market developing so far?
Thank you, Nicolas. First of all, thank you. Nice to see you, and thank you again for having me. It looks like Q3 will be better than the results you've mentioned. We've already booked for the MRs approximately 100% at 21,380. And for the dry bulk, we estimate now for 82% of the Q3 days were booked at approximately 15,500. So numbers look a little bit better than the ones you mentioned. We think that market conditions will remain constructive, especially as we move into a seasonally strong winter period for the refined petroleum products.
So, Eddie, you are operating in 2 shipping sectors, the product tanker sector and the dry bulk sector. So can you take us through the market dynamics and for each sector? Are you optimistic, pessimistic, neutral? Let's start with the product tankers.
Sure, of course. I mean, generally, historically, there has been a reasonable correlation of global GDP growth and demand for seaborne trade of refined petroleum products and many dry bulk commodities, although the latter has been more influenced by growth in China. The latest forecast from the IMF estimate annual global GDP growth is to average around 3% this year and next year. So regarding product tankers, I mean, the latest estimates from the IEA for global oil consumption is less than 1% annual increase through 2026, reaching approximately 105 million barrels per day due to slowing economic activity. The further unwinding of voluntary oil production cuts within the OPEC Plus countries and increasing production in the Americas should lead to an oversupplied market and lower crude oil prices through 2026. However, various geopolitical risks and a weaker US dollar influence oil demand and prices and create arbitrage opportunities. Longer term, net refinery expansion approximately 2.5 million barrels per day by 2030. Substantially in the Middle East and Asia should drive ton-mile expansion and growth for refined products exports from those regions and as well from the US. As regards to supply, uh, by the end of August, the order book stood approximately 260 MR2s. This is the main sector the company is focusing in the product sector. So the MR2s approximately 260, which represents 15% of the worldwide fleet. For the remainder of the year and the next, 151 approximately MRs are scheduled for delivery, and new ordering has slowed dramatically in 2025. Delays also, we expect delays in new building deliveries, which average around 11.5% per year in 23 and 24, and rising demolitions will mitigate the impact of rising tonnage. During the 5-year period, during end 2024, the annual scrapping has averaged approximately 10 vessels, so it's not a lot, but we hope that this will increase in the next couple of years. New building and second-hand prices for the MRs, approximately they're modestly above the 5-year averages, but they're improving, and we think that they will stabilize at least for the remaining period for this winter as demand is coming back on the market. So the current let me give you an indication of 5-year vessel for an MR is approximately 42 million. The total global dry bulk seaborne trade has increased 3.2% in 2024, while the ton miles have risen by approximately 3.6%, as global GDP also grew 3.3%. Chinese GDP growth was 5% last year and is projected to be somewhere close to 4.8%. There is a continuous depressed market in real estate in China with ample domestic inventories, and this has led to less coal and iron ore imports this year. However, global demand for a number of minor bulks have been more resilient. By the end of August, we have estimated that the order books for the two segments, the ones we are focusing, Ultramaxes and Kamsarmaxes, have been quite high. They're approximately now at 25% of the fleet. There have been some significant changes in the market in the last few months. The BDI has increased approximately to 2,205 basis points, which is approximately 50% increase since June 30th, and this is a significant improvement. And a certain brokerage house has recently forecasted a rebound in dry bulk charter rates for 2026, in addition to the seasonal uplift this fall. So for next year, it is estimated that daily rates for Kamsarmaxes would be around 16,600, and for Ultramaxes to improve to 17,000, 17,500.
Eddie, thank you very much for this great detail. Your replies are always very well documented, so thank you very much for providing all this background and all this detail. Now, let me move to a new topic: geopolitics, trade tensions, and the regulatory environment. So, can you give us a broad view on how geopolitics, trade tensions, and the expected tightening of environmental regulations could impact shipping, and how are you positioning Pyxis Tankers to meet these challenges?
Okay, so generally, I mean, the global crude oil markets in September are contending with a difficult mix of steady output growth, moderating demand, and renewed geopolitical pressures, leaving prices under strain and sentiment cautious. Market participants continue to weigh intermittent geopolitical risks and shocks, such as supply risk from disrupted Russian exports, against evidence of persistent surplus elsewhere. Expanding sanctions by the US and the EU against Russian petroleum products, with the prospect of more tariffs coming in the market, such as India and China, I mean, further complicate global trade flows. In addition, macroeconomic factors continue to create an unstable investment environment. However, the possibility of further US Federal Reserve interest rate cuts later this year is being watched closely, as looser conditions could lend some support to energy demand through stronger growth and a softer dollar. At the same time, the shipping industry is trying to develop a global framework for decarbonization that incorporates new rules, technologies, and varying interests of other stakeholders. We are extremely skeptical with the realities of sustainable fuels from the perspective of cost, availability, scalability, and infrastructure development. Protection against shifting environmental regulations are essential for major long-term investments by the industry and advancements of sustainable fuels. We are optimistic for the outlook of the two sectors. We will continue to prudently manage our company from an operational and financial standpoint. We have disciplined allocation of capital and risk management, which are crucial for us to prosper and grow.
Thank you, Eddie. So you opened the door to the next question. Let me talk about capital management and capital return strategy. So last year, Pyxis successfully completed its 3 million common shares share repurchase program and fully redeemed over $10 million worth of convertible preferred shares, which, by the way, eliminated potential aggregate dilution of almost 20%. So what is your capital allocation plan going forward, and under what conditions might you consider reinitiating further share buybacks or implementing a cash dividend program?
Yeah, I mean, we had a large equity repurchase program, which was accretive from a shareholder perspective uh, of book value and earnings per and NAV per share, but contributed to a decline in trading liquidity. After the expiration of the remaining public warrants in October 13th, our equity structure will be simpler with less than 10.5 million common shares outstanding and public float of approximately 4.4 million shares. We expect to use a significant portion of available cash plus the new 45 million loan facility to make vessel acquisitions. In the meantime, we will continue to use operating cash flow to repay bank debt, scheduled and when appropriate, to upgrade our vessels. I mean, for example, we recently installed fuel-saving devices in 2 of the vessels, 2 Kamsarmaxes in the fleet, and we improved significantly their consumptions. We did that in the beginning of the summer when we had the 2 special surveys. Given the prospects of attractive strategic growth investments, at this point, we do not envision the payment of cash dividends or repurchases of additional common shares.
Thank you, Eddie. Now let me turn to your growth strategy. You have recently closed on a commitment from an existing bank for a hunting license loan facility of up to $45 million to finance the potential acquisition of up to 2 modern vessels. And as you disclosed, this could be either product tankers between 45 and 115,000 deadweight, and or dry bulk carriers between 60 and 85,000 deadweight. So how does this initiative align with Pyxis' broader strategy for fleet optimization, and what criteria will guide your decisions between the product tanker market and dry bulk opportunities?
Nick, I mean, we, as you know very well, we diversified the companies from a pure play product tanker company to a mixed fleet. So our focus now is whatever gives value to our shareholders and whatever makes sense. So in that respect, of course, we have focused on the MRs up to LR2s, which is our main focus, but also bulk carriers, mid-sized bulk carriers from Ultramaxes to Kamsarmaxes. We will not rule out any other sector that might give us an opportunity to enter at a low entry point. So we're not ruling anything out. Since we became a diversified shipping company, we will look at other sectors as well. Of course, as you said, the targets need to be relatively modern, eco types. We strongly believe at vessels having eco features, and in that respect, we will invest in vessels with a low age in order for our returns to have, in order for our horizons to be longer and our shareholders to have longer term returns. Also, we're very much price sensitive, and because we want to have a reasonable daily cash break-even level.
Thank you. Now, closing question, key takeaways for investors. Now, for existing shareholders and potential investors who are following your story, what is the key message you would like them to walk away with?
I mean, definitely we have a strength through our diversification by vessel type and chartering employment into, for the moment, two very large, the biggest shipping segments, dry bulk and tankers. We have a strong balance sheet with non-dilutive capital in hand for opportunistic fleet expansion. And we believe at this stage, as we are set up, we can reach 10 vessels easily. The management team is aligned with common shareholders as it owns over 58% of the outstanding shares. And we have a significant potential share price appreciation given Pyxis value proposition and research analysts, more recent price targets, which are averaging $9 per share. So I think these are very attractive reasons for choosing our stock over other shipping companies.
Eddie, thank you very much for being with us today. It's a pleasure to have you again with us, and it's a great opportunity to share your development and especially your vision on the sector outlook and your growth strategy. So we had with us Mr. Eddie Valentis, the Chairman and CEO of Pyxis Tankers. And as a reminder to everybody, this webinar will be available for replay on capitallinkwebinars.com and also on the Capital Link's YouTube channel. And I'd like to thank Eddie and everybody else for being with us today.
Thank you, Nicolas, for having me.